There exists a $600 trillion market that few people truly grasp. Back in 2008, it nearly wiped out the world economy. Now, it's grown to 10 times that size. Warren Buffett labeled derivatives as financial weapons of mass destruction back in 2003. The man wasn't wrong. They sparked Lehman Brothers' downfall, forced AIG's rescue, and almost demolished the entire banking framework. After that mess, did anyone move to eliminate derivatives or at least cut them down? Number. They made them even bigger instead. Today, the derivatives market stands at more than 6 times the value of the entire planet's economy. This thing will blow up, guaranteed. When it does, there won't be enough cash anywhere to fix it. Most folks have never even heard the word derivatives. Even professional money managers struggle to explain what they are. Yet these complicated financial tools sit at the foundation of every major bank, every retirement fund, every insurance outfit, and every government bond market across the globe. They're supposed to lower risk in theory. In reality, they multiply risk, creating leverage on top of leverage on top of leverage. Bets piled on bets until nobody can track who owes what to whom anymore. That's when everything falls apart. In 2008, preventing total financial meltdown required $29 trillion in worldwide bailouts and guarantees. Back then, the derivatives market was around $60 trillion. Today, it's $600 trillion. When this bomb goes off, the blast will be worldwide, instant, and impossible to stop. Understanding why derivatives pose such danger starts with knowing what they actually are. A derivative is a financial contract whose worth comes from an underlying asset. Sounds simple until you realize the underlying asset can be anything. A stock, a bond, a commodity, an interest rate, even weather patterns. The derivative doesn't require you to own the underlying asset. You're just betting which way it moves. Like buying insurance on your neighbor's house burning down. You don't own the house, you just collect if it burns. The most common types are futures, options, swaps, and forwards. Each can serve legitimate purposes. A farmer might lock in wheat prices before harvest. An airline might hedge against rising oil costs. But the derivatives market isn't dominated by farmers. It's dominated by banks making leveraged bets with borrowed money. The notional value of a derivative is the face value of the underlying asset. But the actual money at risk is usually far smaller. If a bank enters a $100 million interest rate swap, it might only put up $1 million in collateral. That's 100 to 1 leverage. If the bet moves 1% against the bank, the collateral vanishes. If it moves 2%, the bank owes money it doesn't have. Multiply that by thousands of contracts across dozens of banks, and you get a system where a small market movement triggers cascading failures. The real problem is complexity. Modern derivatives are so complicated that even the people creating them can't predict how they'll behave under stress. Credit default swaps were supposed to provide insurance against bond defaults. In practice, they became side bets where investors who didn't even own bonds could gamble on whether those bonds would fail. AIG sold hundreds of billions worth without setting aside enough capital. When the housing market crashed, AIG owed more money than it possessed. The U.S. government had to inject $180 billion to prevent AIG from collapsing and taking every major bank with it. But here's what makes derivatives truly terrifying. They create counterparty risk that spreads like a virus. If Bank A owes Bank B money and Bank A fails, Bank B doesn't get paid. Now Bank B can't pay Bank C, and Bank C can't pay Bank D. The failure of one institution cascades through the entire network in hours. That's what happened when Lehman Brothers collapsed. Lehman had over $35 trillion in derivative contracts when it went bankrupt. Every institution that had traded with Lehman suddenly faced losses they hadn't anticipated. The lesson from 2008 should have been to ban or severely limit derivatives. Instead, the Dodd-Frank Act created some reporting requirements, but didn't reduce the total size of the market. Banks argued derivatives were essential. Regulators believed them or were too captured by lobbying to act. The result? The derivatives market grew massively from $60 trillion to over $600 trillion today. Lehman Brothers was America's fourth largest investment bank when it collapsed in September 2008. On its balance sheet, Lehman appeared solvent, but buried in footnotes was the real danger. Lehman had over $35 trillion in notional derivative exposure. These weren't assets Lehman owned. They were bets Lehman had made with counterparties around the world. When housing prices started falling in 2007, those derivatives started losing value. Lehman's counterparties demanded more collateral. Lehman couldn't provide it. AIG's collapse was even more revealing. It showed how a single type of derivative could destroy a company with $1 trillion in assets. AIG had sold about $500 billion worth of credit default swaps. AIG collected premiums and assumed the risk was minimal because housing prices had never fallen nationwide before. When they did fall, AIG owed tens of billions it didn't have. The Federal Reserve stepped in with an $85 billion emergency loan. That wasn't enough. By March 2009, AIG had received $180 billion, the largest bailout in history. But the AIG bailout wasn't really saving AIG. It was a backdoor bailout of every major bank that had bought credit default swaps from AIG. Goldman Sachs received $12.9 billion. Merrill Lynch received $6.8 billion. The government funneled money through AIG to make sure those banks didn't suffer losses. This revealed a dark truth. When derivatives fail, losses get transferred to taxpayers through bailouts. The derivatives market today exceeds $600 trillion. Global GDP is approximately $100 trillion. The derivatives market is 6 times the size of the entire world economy. If even 5% of those derivatives fail, that's $30 trillion in losses, 3 times the total cost of the 2008 bailouts. There is no mechanism and no policy tool that could absorb losses of that magnitude. The largest category is interest rate derivatives, which account for over $500 trillion. These are bets on the direction and volatility of interest rates. When rates are stable, these derivatives appear safe. But when rates move rapidly, the risk explodes. The Federal Reserve raised rates from near zero in 2021 to over 5% by 2023, the fastest hiking cycle in 40 years. Every increase created winners and losers. The losers accumulated losses sitting on bank balance sheets right now, hidden by accounting tricks. The second largest category is credit derivatives, about $50 trillion. These include credit default swaps, the same instruments that destroyed AIG. Corporate debt has exploded since 2018, growing from $2 trillion to over $10 trillion in the U.S. alone. Much of that debt was issued at low rates that no longer exist. As companies refinance at higher rates, some will default. When they do, the credit default swaps will trigger payouts. The derivatives market isn't spread across thousands of institutions. It's concentrated in 4 American banks: JPMorgan Chase, Citibank, Bank of America, and Goldman Sachs. JPMorgan Chase holds approximately $54 trillion in notional exposure. JPMorgan's total assets are about $3.7 trillion, and its equity capital is roughly $300 billion. That means derivative exposure is 180 times its capital. The bank argues notional value overstates the risk because most derivatives are hedged. JP Morgan claims its net exposure is only about $50 billion. This sounds reassuring until you remember that's exactly what Lehman Brothers and AIG said before they collapsed. Their hedges worked until they didn't. When counterparties fail or markets become illiquid, hedges disappear. Citibank holds approximately $48 trillion. Bank of America holds roughly $37 trillion. Goldman Sachs holds $47 trillion. Add these together, and four institutions are carrying about $186 trillion in derivative exposure. The derivatives market has survived 15 years since 2008 without another catastrophic failure, creating the dangerous illusion that reforms worked. But survival isn't stability. The market remained intact because we've been in an unusual period of low interest rates and central bank intervention. That period is ending. The triggers are already appearing. The most obvious is interest rate volatility. Over $500 trillion in derivatives are tied to interest rates. From 2008 to 2021, rates stayed near zero. When the Fed started hiking in 2022, raising rates from 0 to over 5% in 18 months, it created immediate stress. Some pain was visible in the failures of Silicon Valley Bank, Signature Bank, and First Republic in 2023. But most is hidden in derivative positions banks don't have to mark to market. Commercial real estate defaults represent a second major trigger. Over $2 trillion in commercial mortgages must be refinanced over the next 24 months at rates triple what they were originally. Many owners will default because properties can't support the new debt service. Those defaults will trigger credit derivatives. European banking stress represents a third trigger. Credit Suisse collapsed in March 2023. Deutsche Bank faced a credit default swap spike as investors worried about solvency. Both are massive derivative holders, with Deutsche Bank carrying over $40 trillion. The most terrifying aspect is that when it fails, there's no bailout large enough. In 2008, governments and central banks committed about $29 trillion globally. That was roughly 40% of global GDP. It required every major government to coordinate and every central bank to print money simultaneously. It worked barely. The derivatives market today is $600 trillion. If 10% goes bad, that's $60 trillion in losses. More than twice what was required in 2008 and more than half of total global GDP. Governments don't have $60 trillion. They're already drowning in debt from COVID spending and prior bailouts. Central banks could theoretically print the money, but that comes with severe consequences. The Fed's balance sheet expanded from $800 billion before 2008 to $9 trillion at its peak during COVID. That money printing contributed directly to the inflation spike of 2021 to 2023. If the Fed tried to print another $20 trillion, the inflation would be catastrophic. The political will for another bailout doesn't exist. In 2008, the public was shocked but compliant. That acceptance is gone. The last 15 years showed bailouts saved banks, but didn't help ordinary people. Wages stagnated. Housing became unaffordable. Wealth inequality exploded. So here we are, sitting on top of a $600 trillion derivatives market, 10 times larger than the one that nearly destroyed civilization in 2008, held primarily by four banks whose failure would end the modern financial system, facing multiple triggers that will likely activate over the next 12 to 18 months, with no ability to bail it out if it goes wrong. Warren Buffett called derivatives financial weapons of mass destruction in 2003. He's been proven right. The response hasn't been to disarm the weapons. It's been to build bigger ones. The crisis is coming. The only questions are timing and magnitude.